Welcome to this explainer, where we'll break down a fascinating perspective on wealth, inflation, and what constitutes real money.
So let's kick things off with a question you've probably asked yourself recently. You look around and asset prices just keep getting more and more expensive, right? But at the same time, the money in your pocket, it just feels like it's worth less. What is going on?
To find the answer, the analysis we're looking at today says we first need to get our heads around something it calls the illusion of wealth.
Okay, so on the surface, things look pretty good. You see reports all the time about the stock market hitting brand new highs.
And at the same time, the value of property, of real estate, it seems to be constantly on the rise.
You know, this gets reflected on a national scale, too. If you look at official figures like GDP, they appear to show that the economy is growing.
So here's the crucial point. When you see the value of your assets go up like that, it creates this really powerful feeling of increasing wealth. Everybody feels richer.
But what if this feeling is based on a misunderstanding? Let's take a look at the hidden mechanism that this analysis describes.
Now, what's really interesting here is this contrast between what you see, the rising asset prices, the economic growth, and what's really happening underneath it all, which the source argues is currency devaluation.
The engine behind all of this, according to this perspective, is inflation. It's what pushes up the prices of all these assets. And the source argues that this is driven by government policy, ultimately leading to a decrease in the purchasing power of your money.
And this creates a really strange paradox. It can look like the economy is booming, when in fact, the claim here is that it might actually be contracting, maybe even shrinking. So this whole line of thinking leads to a pretty fundamental question. If the currency we're all using is losing its value, what does this source we're examining consider to be real money?
And the source makes a very clear, I'd say pretty provocative distinction. It says that fiat currency, it's not money or real money, and that's absolutely central to its entire argument.
Okay, so let's break that down a little. On one hand, you've got fiat currency. Its value comes from a government decree, right? It's not backed by a physical commodity. But on the other hand, what's being called real money here has intrinsic value. It is a physical commodity.
And this analysis identifies specific commodities that it considers to be real money, mainly because they have that inherent value. We're talking about things like gold and silver.
You know, this isn't some brand new idea. The source points back in history to a time when currencies actually had to be backed by a reserve of real money. Think of the gold standard, for example. In the past, currencies were backed by real money.
Okay, so with this whole framework in mind, how should we think about our own wealth? What's the new view here?
Well, the key takeaway from this perspective is that true wealth isn't measured by the quantity of currency you have. No, it's measured by its purchasing power. What can those dollars or whatever currency actually buy you?
So the whole point of this explainer was to break down this specific viewpoint, and it leaves you with a final, pretty thought-provoking question about how you measure value. The wealth in your hands? How real is it really?